Right, let's go to the first slide. Well, thanks everyone for attending. Leanne's going to just monitor the screen for us because it was difficult to screen share. So can you go through past slide, Leanne, please?
Yeah.
To the first slide. Right, well, thanks for everyone for coming. I don't know who heard me. Aston sent his apologies. He's had some really family troubles with illnesses and things over the recent few weeks, which is why the first one was cancelled, and he's still got them. So we do have some slides for him, but he only got them through late last night. So when we send the recording out, if anybody wants to see any of Aston's, we can let us know, and then we can send his slides, and you can speak to him about it. But just a bit of background about why we're doing the webinar and the presenters today. So Al I've known for quite a while, and Aston I'm familiar with. He actually interviewed me on my podcast, The Build and Exit. Asset sale versus share sale. So I've actually released another podcast this morning, actually, with two other colleagues of mine, Clive and Ollie, because over the next 10 years, predicted baby boomers, there's going to be over 600,000 businesses coming up for sale. The UK economy is quite a serious risk with this because we're really far behind on exit planning, and we find that I've been involved in about 100 acquisitions in different forms, assets, my own and other people's, and 75% of these businesses aren't selling, and majority of them are overvalued and are quite heavily owner operated, which is causing a big disparity in the market where basically there are too many sellers and not enough buyers. But one of the key areas that a lot of people aren't considering is different options when it comes to acquisitions. Most of the time we're seeing just full share sales. And obviously when sellers aren't actually prepared, it may be there's still a viable exit somewhere, and it needs to be a bit more commercially savvy or different to just a traditional share sale. So we thought we'd put this webinar on with some partners who are experienced in acquisitions through sort of their own and, working on other deals. And we'll all go into our own areas. So for me, I own Wilkinson Accounting Solutions. I've had the business about 5 years. We're generally working on about 5 to 7 acquisitions at one time. And like I said, I've personally been involved in about 100, either through the company or through my partners and the podcast and other areas of business that I work on. I'm on a mission to help owners build generational wealth. Because of the disparity in the market and a lot of owners can't sell, it's meaning that a lot of hard work is going down the drain. And the reality is at the minute it's a buyer's market. Buyers are swooping in, getting good deals on acquisitions because sellers are unprepared. So they either have to, voluntary liquidations are going through the roof. They're either closing down businesses because they're hard to sell and they've got high assets, or buyers are getting pretty good deals coming in. So we're on a mission to try and change this and, align sort of sellers to buyers. And I think people understanding their options when it comes to acquisition is a key part of that. So the agenda today will be the intro I've done. Al's going to come up first, and he's going to talk about legal considerations, share sale versus asset sale. I'm going to then talk about sort of from a buy side consideration perspective on sort of commercial reasonings, but also we're going to touch a bit on some tax and VAT. As you can imagine, the tax manual for acquisitions is 100 pages long, so I'm not going to sit here and bore you with tax, but we will just touch on some key points that sometimes are key considerations. And obviously Aston was going to come in talking because he sold via asset sales. He did one recently actually, so it's a bit of a shame because he was going to show from why a seller would do a acquisition from an asset sale. But anyway, like I say, his slides will be available should anyone want to see them at the end. And then at the end we'll do some Q&A. It's going to be we propose it will probably be shorter than expected because obviously with Aston not presenting, but we will have time at the end for Q&A, and me and Al have both got some war stories and lots of things that we can go into, so it can go on, and I'm sure we'll have some exciting conversations after the detail. So are you ready, Al? Brilliant.
Yep.
Do you want to intro yourself and take the lead?
Yep. By all means, thanks, Julie, for that introduction. So for those who don't know me, I'm Al Zucker. I am a solicitor, legal consultant at Ignition Law, amongst other things. At Ignition Law, I specialize in helping founders and firms raise capital, acquire other businesses, and eventually exit. So I'm basically a minority investments and M&A guy. I do things both buy side and sell side. I think over the course of my career now, I'm probably about 250 transactions, something like that. I'm no longer counting. I've done them at sort of all levels of the market, from very large to 5-figure, 6-figure deals. So hopefully I've covered a whole range of different sizes and levels of complexity. And alongside my legal practice, I also founded a business 2 years ago with a former colleague, which acquires manufacturing and engineering firms. And Julie and I've done actually a podcast on that before. So if you want to listen, that's available on her feed. I actually recently exited our first business. And we did that via an asset sale, as it happens. So, Julie, if you want to talk about that at the end, we can maybe talk a little bit about that, how that happened. But I think principally, certainly in the first chunk of the session, the plan is to talk at a kind of high level about share deals versus asset deals and what you're likely to find, in terms of the legal documentation and the legal provisions that you're likely to find if you go through an asset sale rather than a share sale. Could we go next slide, please, Liam? Intro slide. Yep. Okay, great. So this is really what I'm going to try and cover. So we're going to keep it high level. We're going to talk about when you typically see them. We'll talk a little bit about the approach to due diligence, the anatomy to the APA, and TUPE, which is employment, which is a key consideration that we'll want to talk about. As I say, it is high level. If you want specific advice, please do, ideally get in touch with me. But if not, find a competent lawyer who knows what they're doing. Right. So at the very highest level, the difference between a share sale and an asset sale is really down to what asset you purchase. So if you do a share sale, you're buying one asset, which is the shares in the target company. And maybe if that's a holding company, there may be other companies inside a larger group. The implication of that, however, is that you get everything that comes with that business, assets and liabilities, including things that you might not know about. So the analogy that I like to give is, imagine you've gone shopping and there's a sort of discarded shopping trolley at the side of the car park, and you take the whole shopping trolley. You get whatever you find in it, good and bad. Asset deals are very different, because what you do is you go through the asset base of the business, and indeed the liabilities, as we'll come on to talk about in a second. But you go through and you pick one by one, contract by contract, fixed asset by fixed asset, the things that you want, and you have to then transfer those things, if you like, manually from seller to buyer, and attach a price to each thing or each category of things. Nothing transfers automatically, with the exception of employees, which we will come back to, and a few other bits and pieces around sometimes environmental liabilities, but again, that's kind of slightly specialist stuff. Which one you choose is highly tax driven. So in the UK, and I know Julie's going to talk about this in a second, so I don't want to sort of steal her thunder, but in the UK, share sales are, generally speaking, much more efficient for sellers than asset deals. And so sellers will push, where at all possible, to do a share sale rather than an asset sale, because one is it's less detailed, because you're just buying shares. It pushes risk onto the buyer. And two, it's more tax efficient for the seller. And that is something that's not true everywhere. So, if you're reading a lot of, say, entrepreneurship through acquisition stuff out of the United States, you'll see they're talking a lot about asset deals, and they do them all the time. That is how it works in the States, but this is super jurisdiction specific. So if you're doing M&A in the UK, make sure that you get the right tax advice rather than relying on stuff you're reading out of the US, because this does change very drastically from place to place. Next slide, please. So when do you see asset sales? There are really two categories of time where you see them. So the first one is what I've called insolvencies or special situations. So where somebody has gone bust, it is often the case that a buyer swoops in and for a low price cherry picks the things that they want for cash, and then the administrator, the liquidator, whoever it is who's running that insolvency process, then uses that cash to pay creditors, and if there's anything left, then it goes to the shareholders if it's solvent. You also see them in situations where a target has not necessarily gone bust, but is in a lot of trouble. So I've certainly seen deals done before where a seller is carrying a lot of tax losses, and so it doesn't matter how it's sold because there's so many tax losses in the seller that they're not going to be paying any corporation tax on the sale anyway, in which case for the seller it's quite a nice thing because the seller gets a load of cash in, he gets to keep all its receivables, so all its existing assets, and so it gets all the cash from those as well, which it can then use for whatever it wants, really. So what I know I said at the top is they're usually tax inefficient, but they're tax inefficient until they're not, and it's obviously very highly fact sensitive. So you do see them, particularly where people are in trouble, is I think the takeaway. So don't dismiss them, particularly if you're looking at deals where somebody is struggling a little bit. The other place you see them typically is where you have, say, two business units that are in a single company and you're only buying one of them. So let's just take a hypothetical example. You've got a manufacturing business with two sites, a site in the north of England and a site in the south of England, and you are only buying the north of England site out of the company. You have no option really under those circumstances other than to do an asset deal, because you have to break these two business units apart, and that entails an asset deal. Next slide, please. Due diligence. Right. With that in mind, the way in which you approach DD, certainly from the legal side, and Julie, if you've got anything to add on the sort of more commercial financial side, please do so. The type of deal structure does very much drive how you go about doing the due diligence. So on a share deal, you have to turn over every stone because you're getting the lot. And if you don't turn over those stones, you're on risk for it anyway. With an asset deal, because you're picking the assets that you want, in this instance, taking the shopping trolley analogy, you take the empty shopping cart and you go around the supermarket and you pick out all the things that you want. What your due diligence is focused in a slightly different way, because firstly, you've got to work out what it is you want to put inside the trolley that you are then going to purchase. And the other thing that you're looking for is specific problems with those assets that you are planning on buying. So it's a much more focused exercise, and it's an exercise with a slightly different emphasis because you're looking for these much more specific things. And then I've put a list on this slide in terms of sort of the key questions that you're asking often doing asset style M&A, which is, do they actually own the assets? So you're checking that the contracts are in the name of the right party. You're looking at a fixed asset register and various other things to make sure that they own what they say they own. Are there any things that affect the value of those assets? So, are there, if you're looking at commercial contracts, say, that you're trying to assign, are there crappy payment terms? Are there indemnities? Are there provisions around rebates? That means that actually the things that the cash flows that you think you're getting are not necessarily the cash flows that you're actually getting. Do you need any consents? Often if you're assigning contracts, there will be assignment, consents for assignment. There might be change of control provisions. There may be termination provisions around cessation of business operations. There's all sorts of things that as lawyers we're going through contracts looking for. And then you need to identify the practical steps necessary to take control. So there might be critical accounts, social media accounts. I used to do a lot of these in e-commerce, so getting hands on eBay accounts, Amazon Seller Central accounts, all of that sort of stuff is really important. And then how you then, again using the e-commerce example, migrate key suppliers like warehouses, other supply chain partners, and so on. Something that you want to get out in front of before you buy, because on day one you have this sort of like cut over where everything moves across, and you want to be basically getting your hands on those key accounts and relationships in a matter of hours, minutes if not hours, rather than days, to prevent significant business interruption. So you've got to plan for that in a way you don't if you're doing a share deal, because if you've got contracts in the name of the target and you buy the target, subject to there not being terminations for change of control or whatever, nothing changes. And so you don't have that same level of disruption. Next slide, please. Yeah, so again, I've talked to quite a bit of this already, but these are the sorts of things that you're going to get your lawyers to look at. Does the seller, company search, which you do on a share deal or an asset deal, does the seller exist? Who controls it? How do you make sure that you have confidence that they can sell the things that they're saying they're going to sell? Do they own the assets? Are they encumbered? And then various other things that we've already discussed, issues around what's being purchased. So we've talked about the first one, restrictions on use of assets. So there may be, if you're licensing IP in, are there restrictions on what you can do with it? Encumbrances are essentially bank security. So if the seller has borrowed money, they may not just be able to transfer assets without bank consent. So you need to get out in front of getting those consents and those security releases from the lender, so that on the completion day you can actually take the assets without creating a problem, and so on and so on and so on. So that's again a bit more of a flavor as to what sort of thing you're looking for. Again, this we've somewhat talked to already, but we, as a part of this exercise, you need to work out, you basically bucket all of these things up, and then you work out how you're going to transfer them one by one. We talked about integration already, and yeah, you've just got to keep an eye on it all and make sure that for completion you are ready in a way that you don't with a share deal where effectively money moves, you change your directors over and you continue as usual, basically. Next slide. Right. So I'll just try and give a bit of an overview without getting too bogged down in the detail as to what goes into the purchase agreement and how they might look a little bit different from share purchase agreements if you're used to those. So in a share purchase agreement, before we get into the detail here for those who maybe haven't seen one, in effect what you have is one key clause and then a whole load of stuff that goes on around that clause, and that key clause is the buyer shall buy and the shall sell the shares on completion. And then you sort of build everything up from there around risk allocation. So you have all sorts of provisions around the process. You have provisions around risk allocation. You have provisions around pricing, and so on and so forth. But really, that one clause, the sale and purchase clause, is quite simple. I guess for the reasons that we have discussed. You're actually buying quite a simple thing when you do a share deal. In an asset deal, again, as we've discussed, things are a bit different because you're buying lots and lots of things. So the buyer's lawyers typically draft it, and that goes on a share purchase as well. Normally the buyer's lawyers put the documents together because it's their deal and they're the ones handing over the money, I think is the rationale. you'll have a look and see whether there are any what are called conditions precedent. So these are essentially conditions that need to be satisfied before the deal can go ahead. Often you see these for regulated industries. So if you're doing things in, say, insurance, banking, various other types of industries, there may well be regulator consents. If you're doing these at the very, very large end as well, you'll be looking at competition consents, but that's probably less relevant to SMEs. And then one that is always worth thinking about very early on deals these days is around national security. So there are 17 regulated sectors which require notification these days to the business, to BAYS, I think it is. There's a portal for it. Failing to notify is a criminal offence, and I think recent data suggests that about 40% of M&A in the UK falls into one of these sectors one way or another. There are a lot of deals that should be notified that aren't, and sort of it's worth checking the list and getting out in front of that very early, because the consequences of not getting the consent if you need it are pretty drastic. So just be aware and ask your lawyers to check right at the beginning. Most of the time they go through fine, unless you're buying using, I don't know, Iranian money or something crazy. You're not going to have a problem getting these consents, but it does add a layer of process, and it adds about 6 weeks to the timeline. So it's definitely worth thinking about at the beginning of your transaction rather than at the end of it. So be aware of that. Yeah, and then sort of the sale and purchase clause is a lot more complicated in an asset deal, because what you've got to do is you're putting things into one of 4 buckets: included and excluded assets and included and excluded liabilities. So essentially what you're saying is these are the assets that I am buying, these are the assets that I am not buying, these are the, if you like, the bills of the company that I am going to pick up, and these are the bills that I am not going to pick up. And then what you have is you have reams and reams of details. So like basically long lists of stuff that sit in schedules to the document that detail out exactly which thing sits in which bucket, so that you have a very clearly delineated transaction perimeter and everybody knows what is coming across on day one. Next slide. You then have provisions that talk about the mechanics of transfer. So contract assignments, conveyance of real estate if you're buying real estate, IP assignments, and so on. And you probably have a whole plethora of additional documents that are typically much shorter, but which, if you like, affect each of those individual transfers. Sometimes they're done in the document as well. It depends on how people do it, but you actually have to physically do those transfers, right? Then have a provision around pricing and cash. So obviously you're paying something, but it's often broken out by asset type. So you might be paying X for the contract, Y for the property, Z for the IP, and so on. That allocation sounds easy, and again, this is more of a Julie thing than a me thing, because it's quite heavily tax driven and accountancy driven, because you can get sort of benefits around step up in asset value, and you can do clever things around depreciation and all sorts of things if depending on how you allocate it. And some things are better for the buyer and some things are better for the seller, so you end up having a bit of a horse trade normally on the PPA. That's the purchase price allocation, so that you kind of get to a fair outcome. If the business has got a lot of inventory that's coming across, you might see a sort of short form set of completion accounts or an inventory adjustment. So essentially people pay for the inventory that you have at completion. That essentially involves going in on completion or very shortly afterwards, doing a stock count and then tweaking the price for the exact amount of stock that the business holds. And then you'll also agree an approach to debtors and creditors. So the risk on an asset deal is that the buyer gets a bunch of customers and then the seller goes hounding those customers for unpaid invoices and damages the relationship with those customers. So there are a number of ways to skin that cat, but essentially what you will agree is a fair approach to collection of invoices, so that good customer relationships are not destroyed by an overly aggressive seller. Sometimes, and they really fall into two buckets. Sometimes the seller collects, but there are safeguards. Sometimes the buyer does it and then remits the cash, and sometimes they charge a little tiny commission for the hassle of actually having their staff like do the debt collection. And sometimes the buyer just pays for them and then collects them themselves. And there's no right answer to this. It's just a question of what's going to work in any particular circumstance and what the parties are comfortable with. Next slide. Yep. You then get a lot of stuff around risk allocation, which is very much the purview of the lawyers. So you have warranties, which again, if you're used to seeing share purchase agreements, they're a lot shorter because you only get warranties on the stuff that you're buying. So if there's lots of things that you're leaving behind, you obviously don't need to know about them, and so you're not asking questions. So you can maybe expect half to 2/3 of the warranties that you would see on a share deal. So I've lost my train of thought. Yeah, so that's the warranties. You are less likely to see specific indemnities because there's you probably just leave nasty things behind. As it says on the slide, the liabilities generally remain for the seller, except for TUPE, and we'll come back to it. We'll come back to TUPE because it's important. And then, yeah, you might have something to deal with any liabilities if contracts are novated and they come with obligations. But again, it's a limited bucket of stuff. You'll see limitations on the seller's liability. So liability in M&A is never uncapped. And you have a set of provisions that deal with essentially the caps on liability and any other restrictions on when and how people can claim. You'll see restrictive covenants. So this is basically a list of promises that the seller makes to the buyer and possibly the seller's shareholders as well. In an asset deal, you're probably more interested in what the owners go off and do than you are in what an empty shell goes off and does. To ensure that they don't compete. But it might cover other things as well. And then you will have provisions around TUPE. And essentially the way this works, and we've got further slides, so I will talk to it a bit later, but effectively employees transfer automatically in the UK if a business unit is transferring. Now, whether or not it applies requires a bit of analysis, and you need to get specialist help to work out whether or not you are automatically taking on employees. But on the assumption that you are, you essentially need to deal with who takes on what liabilities for what point in time, and you tend to draw the cutoff line at completion. And so pre-completion liabilities lie with the seller, post-completion liabilities lie with the buyer, and you get, if you like, an indemnity each way, so that only one party is on the hook, or at least that's the theory. Next slide. In terms of other things, yep, there'll be a disclosure letter in all likelihood. So again, if you've been through a share deal or you know how that works, warranties are qualified by disclosure. The same applies on an asset deal. It's likely to be shorter, but you still go through the exercise. And then you have these ancillary documents. So all of these additional bits of paper to actually transfer stuff. Buyer board minutes, seller board minutes, various other bits and pieces. It's sort of quite fact specific as to exactly what you have, but there's always a ream of relatively straightforward documents that the lawyers need to prepare in order to affect one of these things. Right, so TUPE. Next slide, please. So I am not a TUPE expert, but I know I've done enough of these to sort of broadly talk to it. So essentially, legislation deriving from EU employment rights law has been on the books in the UK for a long time, which essentially provides that where you're acquiring some or all of the assets of a business, or where there is a change of service provider, employees are likely to transfer. And there are three key principles underlying the legislation. Essentially, that it's designed to protect employees from dismissal in connection with the transfer. So this is people where you do an asset deal, they just get sacked. There's what's called the automatic transfer principle, which is this idea that you can't contract out. They're coming, whether or not you like them. And there's also information and consultation obligations with varying degrees of intensity, as I recall, depending on exactly how many people are going. And it applies to all of those people who are employed immediately prior to the transfer. This gives you a little bit of a sense of what a consultation might look like. So there is a requirement to inform and consult, you can see at the bottom. And then there is also a requirement to provide the buyer with various information around employee liability. What that means is you need to be getting out in front of these things quite quickly, because as you can see, you've got 28 days, you've got to deliver some of that information 28 days before the completion date. So you need to be organized to ensure that you can comply with your TUPE obligations. These obligations may be a reason why you split exchange and completion, because what you might do is you might agree to purchase, you might then go through a TUPE process, and then at the end of that process, you then close. So, this is an area where, depending on how big your business is and whether TUPE applies, you're going to want to get out in front of the employment issues quite quickly, because a bit like with the national security stuff, this can end up driving timetable in a way that you're not necessarily constrained by if you are looking at a share deal. Just a few watch outs for TUPE as well here. So if you try and exclude it, your contract is void, which is a disaster, right? Because you potentially have to unwind the entire transaction. For what it's worth, it's actually the same with national security legislation. So it's another reason to get out in front of that. And then, as we described a bit earlier, the way you deal with this is by drawing a line in the sand. So you put a line in the sand at completion, and you indemnify each way, and you also get various warranties around employment and also undertakings from the seller to confirm compliance with TUPE, and then you can obviously verify that as you go through the process if you've got a split exchange and completion. And as I say, you get these indemnities because actually both parties are on the hook. The employees can go after buyer or seller if the process is not properly complied with. So you get the indemnity so that the seller is liable up until completion and the buyer onwards. Next slide. So that was all I had to say, trying to keep it high level. Julie, I guess over to you.
Yeah, thanks, Al. I'm wondering, it might be easier if I share for mine, because mine points come in at different stages.
Yeah, okay. I'll stop sharing.
No, I'll share because I've got it open. Second. Hopefully it works. Can you see it?
Yeah.
Yeah. Okay. Okay, so I'm gonna. I gave a bit of an intro earlier. I'm going to come from a buyer side and look at some commercial reasonings, and also I'll just give some examples of things I've seen in terms of asset and share sales as well. So I did an asset sale myself. So I acquired 100 clients off another business, and we did it through an asset sale. And so I'll talk through some bits about things that I found sort of from the seller and buyer side as we go through. So buyer consideration. So why might people do an asset sale? I mean, Al touched upon it earlier, especially in terms of tax, but there are some reasons why businesses, for commercial reasons, may sell through an asset sale as well. So obviously, Al touched on it. Seller might have financial difficulties, have high risk liabilities, but buyer feels they can utilise the assets. So that would mean, they don't want to take on the risk of the balance sheet. which is so they wouldn't buy the shares, and it's going down the insolvency route, effectively, that Al talked about earlier. The buyer may need certain assets, which is expensive to integrate organically. That's why buyers typically get attracted to asset sales. Obviously, it is it's not as tax effective for the seller, which we'll talk about. But obviously, depending on the seller and their situation, they may want to offload assets. Perhaps they don't need them anymore for their business and the buyer can take them. Or maybe the seller is going through an insolvency or financial difficulties and kind of has to sell them for a cash flow reason. And then buyer considerations, economies of scale. So onboarding assets commercially can be quite good, especially for economies of scale in terms of consolidation of costs. So for example, when I acquired my clients, my insurance is based on level of risk, not number of clients. So we could acquire a high number of clients into our practice without a need for an insurance increase, as an example. And that's just one area where you can get economies of scales. And obviously, depending on the size of the business you're buying and the type of business, for example, if you're like an e-commerce business, so you're selling stock, you generally get a lower price point if you're buying higher quantities of volume. So, if you bought 1,000 customers or 2,000 customers to bolt onto yours, it may give you an economies of scale across your whole business. And people can get, 35 to 50% sort of margin improvements. So my year-on-year profits, we actually have owned our acquisition by this March. We've had it 2 years. We had a 12 to 18 month integration where we did have to sort of streamline cash and operations. And I think we're about 200% up on profit year on year now. And we've only really increased sales by about 20%. So it just goes to show that, sometimes it is a bit of a long-term gain. It's not everything's always immediate. So you have to accept that, if you're onboarding, there may be dual costs for a time. So other buyer considerations, I'll put them on screen so you can see them. Oops. Okay, so commercially then, why may people want to do asset sales? So do you need assets to grow your operations? Which is now a seller may want to sell their assets through an asset sale. So where I've seen it in the past is people have traded and then set up multiple income streams through one entity. So perhaps they haven't set up holding companies or SPVs or a group structure. So now they've got 4 or 5 sort of different income streams, so different customers, different assets flowing in. And it may be one of those assets to them just isn't viable anymore. Like, it may not necessarily be that it's going insolvent, but they don't like it anymore. They want to go into different avenues. They've perhaps found other acquisitions they want to buy. So therefore, because the group's consolidated and you've got this profit and loss that's got multiple income streams, some people just choose to bite the bullet and go, look, I don't want that part of the asset. I'm going to sell it off. And yeah, it's not that tax effective, but ultimately they're looking at a long-term gain, because it might be they're also going to acquire in the background and spearhead their own acquisition. So that type of thing. And it is relatively complicated at that point, because especially if you don't have management accounts, you've got to be able to obviously apportion all of your costings and make sure that you're valuing your assets. And going back to what I said at the beginning about how so many sellers aren't selling, this goes for asset sales and for share sales, because the last thing you want to do is go to market, spend a lot of money trying to advertise your business, not really know what your valuation is as a seller, and then find a buyer to find out actually whether it's the full company or it's the assets. You could have a similar risk of that you've overinflated or even underinflated in some cases, but mainly it's overinflated certain assets. And in the end, because you can spend a lot of money getting to that point without really knowing. So, I came from a buyer side, but when we work with people, we're working on buy and sell, not on the same transaction, but we see it from different sides. And I would say, from a buy side, you want to be, you can get some good deals in asset sales. And if you're a seller who's considering selling, or you've got income streams that you want to get rid of, I would say that, I'd be doing some setup in the company, making sure you've got the right profits, management accounts, information, because even though you may not sell the full balance sheet, you're still going to need management accounts and balance sheet splits, because that's how you're going to value the overriding valuation of the assets or the business. Customers, transferring brand. So when we took on our customers, we had to send out all new contracts, for instance, because obviously they came under, we didn't buy the shares, so it had to come under our insurances, which meant it came under our money laundering regulations. So it is quite administrative burden. When you buy shares, you take the running of the company, so you do take the risk of the company, but I suppose everything's set up, the systems are there, the contracts are there, or should be if you've had the legals, and you just carry on the trade. So I think asset sales are generally more administrative burdens, but perhaps longer term gains than the share sale if you can grow your own business from it. Supplier integrations. So it can mean dual running costs. So we had dual running costs. So with the 2P and the staff coming over, like I was just, it may be you have got need for people in your group, but perhaps not in the roles that they came over, but that can take time to integrate. And I would say realistically, when we send all our contracts out, it took us 4 to 6 months probably to really onboard and get all of the sort of admin side of onboarding and acquisition, asset sale into the business. So it's not a short-term thing. It takes a bit of time to do it. And obviously there's a cost there because you need an administrator or someone to help you do it. Staff performance, are they impacting operations? So, it's really hard. I've been through it. I got staff through 2P, and you can do your due diligence, but in the end, it's very hard to know someone's personality, a culture of a business. It's very difficult to get to that level of detail. You can do your best to get all charts. But you have to face the reality that you could get staff to come over that perhaps will impact the operations if they're not fit for purpose, and obviously you'll have to go through those measures to make sure you're following legislation. System integration. So we have the system. So this is where asset sales are quite good for buyers. If you're going into a market that's completely unknown and you don't have a bolt on, perhaps an asset sale is not the best thing, because you may need to acquire all of the assets and technology to run that business. But if you've got access to systems and assets where you can bolt customers and other or align systems, then that's where people, I think, get the real benefit from asset sales on the buy side. Fee structures. So when were the last pay rises? For employees, and also when the people uplifted customers, sort of fees for customers. I think you have similar issues but especially if you're buying customers and trade receivables, and even trade payables, like looking at maybe have suppliers actually increase their fees. Is a big cost increase coming. Have people gone through a turn of getting lower costs because of a relationship that the seller's got with a third party, and you might not have those. If you're taking on the assets, I think you can get these issues, assets or share sales. So it's important to look at, obviously when you take on the customers, they're going to be part of your brand, your pricing, your assets. So you need to make sure that it's not going to cause you issues, because ultimately, I think asset sales are harder, especially if you're transferring customers, because when they transfer brand and it's a different brand to where it was, it causes a level of uncertainty for them, I suppose, that maybe isn't there with a share sale, because they're aware the brand's changing. And then, do you need a holding company? So we'll talk through the taxings, but typically when you're buying an asset sale, it's going into your current operations. So it will come into your own company and it will form part of your balance sheets. If you're buying shares, most people are doing it through the holding company and an SPV, which essentially means you have different limited companies set up to acquire different assets. And a reason people do it through holding companies and SPVs is because it mitigates risk. So one of the key things we look at a lot is risk mitigation. So if you do buy assets or businesses and they're in different limited companies, if there's any insolvency risk if anything ever goes wrong, assets can be protected in other entities that aren't in one company. So that's sometimes the reason why people might do asset sales as well from a sell side, because they feel there could be risk to an asset for them, which a third party may be able to take on and reduce that risk. So I think the principle is, I do believe buyers face similar issues with assets and share sales. Different risks, because obviously with an asset sale you don't take on all the financial liabilities and financial risks, but there can still be financial risks commercially on a buy side, because obviously you can have halted operations and issues with customers, Al mentioned about the debt chasing. So when we did ours, we didn't bring over the age receivables. We just brought over the starting point of when we were transacting, and we had a methodology behind the scene to calculate sort of work in progress or prepaid or in arrears with the customers, and we just worked that out as part of the sale price. So we never had any of that. We did all those calculations behind the scenes. And obviously, the bigger the business you're buying, the more complicated it can be. So I'm just going to do some top level of tax. Obviously, this is UK law, like Al said, it is different across the whole world of sort of tax treatment. So this is focusing more on UK law. So when a buyer acquires the assets, I mean, I put goodwill here, but ultimately, depending on what assets you're buying. So if you bought inventory, then inventory would be going into your stock. But when you're buying customers, you're buying an element of goodwill, which falls part of your intangible assets. And one of the considerations, and this is similar with share sales and asset sales, is where you're going to allocate, your legal, professional, and broker fees. When you do a share sale as a buyer, so normally the setup is the owner, you as the person, have 100% shares in the holding company, which is the top co. So that's the top company of the group. Then the holding company will own shares in its subsidiaries, which are these SPVs, which are effectively just limited companies underneath it. And those companies are acquiring the assets of the targets. And the reason for that is the transfer of dividends across groups. So you can transfer cash through dividends through group entities tax-free, to allow cash to flow up to the holding entities where it's more protected without tax. Then obviously the owner can then choose how it distributes those reserves to itself when they want to take the dividends. When people own multiple entities, and we see this through acquisitions in general, if you've set organic business up, it becomes very complicated to be able to manage your own tax affairs. If you're taking lots of money from lots of different companies, you might have 5 or 6 in the group, and you're trying to take money from everywhere, and tax bills rise quite quickly personally if you don't keep control. So group entities are pretty good for dividend distribution and cash transfers. So that's why on a limit, when you're doing a share sale, you tend to do that structure. Obviously, on an asset sale, you'd typically be bringing it into your own entity anyway. And one thing to be mindful of is there is a cost. Most people are spending anywhere between 25 to 50 grand on setup fees of acquisitions, and I think it's similar whether you're looking at asset sale or share sale. When you look at legals, accounting, stamp duties, maybe HR experts, you might be looking at having IT, DD, depending on what you're buying. When you're acquiring the shares of a company, at the holding company, you're acquiring the shares personally. So any fees associated to those shares would typically be cast as a personal sale, and therefore fall outside of the purchase, and therefore it wouldn't be an allowable expense, and you would capitalise it. And similar mechanisms on asset sales, where the treatment is legal and professionals generally would form part of the goodwill. So it just means that if you're spending a lot of money on legal and professional fees as part of the deal, it doesn't always get a tax benefit in that year where you can release it. There are, like I say, the tax manual is really complicated. It's about 100 pages long. What I would say is, I think in principle, anything prior to heads of terms is what they would call management decisions, because you're making decisions, are you going to acquire a target? So once you're moving up to heads of terms, some of those fees may be allowable as expenses. Once you've actually signed heads of terms and you've moved on to the agreements, asset or share, typically the guidance from HMRC around it's very difficult to say that anything around those transactions aren't related to a personal decision, because you're deciding. Although there may be some opportunity to look at transactionally what you're doing to see where, for example, if you had a cash flow built and you're consolidating into your group, would you have done the cash flow anyway? So I think the important thing around your tax and your spend is you keep good log. And if you're going to do multiple acquisitions, you need to keep consistent in terms of how you're going to record and report transactions. But I think the goodwill and the professional fees is something that catches a lot of people out. So that's the one thing I put on there. But you do need to get advice on each individual transaction, purely because obviously every scenario is slightly different, and businesses are slightly set up different. From a seller side, when you're selling assets, so this is why asset sales are more favourable for buyers and sellers. So you get sort of a double tax. So when you sell an asset, obviously you calculate a net gain because you may have costs associated to it, but the net gain is effectively ends up becoming a form of income tax because you sell it. So if you sell inventory, for instance, that will just be an inventory sale. So what happens is you get corporation tax on that income. And then obviously that's now cash in the business, and for you to draw it out becomes a director's loan, which then you have to report to a dividend. So it's like the double taxation hit in corporation tax and in dividends, and with obviously tax rates going up. But like Al said, and we've thought about, there could be reasons why you would still do it, even though the tax is quite high, because it might be a commercial strategy over a number of years. When you sell shares, you'll be taxed at the capital gains tax rates because you're selling a personal asset and you're selling the one asset. And I'm just going to briefly touch over business asset disposal relief, and just on the next slide. I'm sure we're all aware of the budget and the tax hikes. I haven't really gone into the tax rates on here because the tax is probably a whole nother webinar. But just a brief summary of business asset disposal relief. So the reason it's there is it lets you pay less capital gains when you dispose of assets. And there are some criterias. To qualify, you've got to apply at least 2 years. The following must apply for 2 years up to the date when you sell the shares. So you are an employee of the company. So thinking of your own companies, if you're going to sell, do you have an employee contract? These are the types of things. These are the types of reasons why businesses end up not selling when buyers come, because it's type of things like, a director of a business just doesn't have an employee contract. And therefore there's nothing in place to say what the remuneration should be, or is the profit and loss commercially viable for the salary. And the company's main activities are in trading. So non-trading activities are like investment companies. So that could include property. So if you've got a lot of property businesses in limited companies, or it's a holding company of a trading group. So there are quite a lot of considerations around business asset disposal relief, how you actually acquire the shares in the first place, and also obviously your own personal tax situation on your tax rates and which thresholds you would sit into. But that's just a brief summary of why obviously a share sale is more tax effective than the asset sale for a seller. So I will do some questions at the end, and I'll maybe able to help with legals if you have any, because obviously I know it's a lot to take in. So on VAT considerations, so I've just brought VAT up because there are some things to consider. So on an asset sale, we have this term called transfer of going concern, which effectively means if two businesses are VAT registered, there's an application that can apply to sort of remove the VAT element of the sale. And I'll let Al maybe briefly touch on the legal side of that. But the one that catches a lot of people out, which is something you should consider as a seller and look at as a buyer, is property. So property is generally exempt from tax when you first acquire. And obviously commercial property, the landlord of that can choose to opt to tax their property. And the reason they do that is because when they trade through that property, it allows them to reclaim the VAT as they go along on sort of works done for the property, and then they will be charging VAT to their tenants. But when that seller comes to sell, if they've opted to tax, it would obviously, the sale would then will become a taxable supply for VAT. So the buyer has to be aware of that when they're buying. And there are some quite strict legislations in place in terms of like when the VAT can claim and when all this has to be done. So if you are doing an asset sale that does, and you are acquiring a property, make sure you get your legals and your professionals to help you look at it, because if the seller has opted to tax, then the buyer may have an opportunity to make sure they're VAT registered to reclaim it, and that might mean they have to opt to tax as well. So there's a timing difference. So this is a brief overview of it, but it is something that catches people out. And then seller fees is a big one that I see on both sides, more share sales probably than asset sales. So what I tend to find is when people are working out excess cash and they're working out like what the deferrals are and what the upfront payment is, often the sellers will say to the buyers, if you just pay my broker fees rather than paying me the cash, it's really tax effective for the business. So you have to be really careful because taxable supplies don't include personal costs. So if a seller has their own fees for selling their shares, that will be classed as a personal expense to that seller, and therefore it will never become it's unlikely to ever become a taxable supply of the business. That doesn't mean you can't pay it for them because it's just a cash transfer, but it's not. But I think a lot of sellers are trying to say to buyers, and this is just what they believe, it's tax effective, you can put it through as a cost and deduct the tax and deduct the VAT. That wouldn't technically be right. You'd typically restrict those costs anyway. So you could pay it and then lose out because you'd be paying gross, not net in terms of VAT. So it can be done. It's not saying you can't pay for them because obviously you're just looking at how you're transferring cash at the end of the day. But you just want to be careful on what you're agreeing and making sure you're not losing out on the deferred on your upfront and the excess cash workings. So that's my... So like I say, Al can't be with us. Some people came in later, so you may not have heard at the beginning. Aston, can't be with us. He's had some real bad family illnesses over the last couple of weeks. But he has got some slides because we're obviously recording this so we can distribute it at the end. But we're sort of coming to the end of the presentation then, so we can open it up to Q&A because we've got some time. Does anyone have any questions that they want to ask?
Yeah, Julie, hi. Thanks for that. That was really interesting. I did have a question, just something you mentioned around the timing of if you're considering a sale, your pre-heads of terms. You mentioned anything after heads of terms, HMRC expects that professional fees are then, I guess, a personal liability. Could you maybe just go into a little bit more detail about that timing?
Yeah, so what they look at in tax is they call it taxable supply. That's like the technical terminology. And what they're looking at is saying who is choosing to spend this cost. So when you're buying a share, technically as the person buying the shares, you have to distinguish is that cost actually for you as a person or is it for the business? Now, the reality is, although, yes, you will take over that business, a lot of your professional fees are actually in relation to your element of acquiring those shares. So that's where it becomes like tricky in terms of like, is it actually a business cost which is allowable for tax or is it a personal cost? So the reason, not every time, so you do have to look at each individual transaction, but the reason we look at when we get to heads of terms, so let's just say you have a business now and you're trading and you're looking at acquiring, you might bring in an accountant to value, or you might bring in Al to look at some of the legals on it. You would look at that, you're kind of making a management decision there, like any sort of business transaction. You're going, should I do this decision? That's no different really from you going, well, should I do this strategy or should I do that strategy? And that's typically how it can be viewed. So I think prior to heads of terms, you're looking at management decisions where you're deciding, are you going to do something for the growth of the business? But once you sign on the heads of terms, you've just got to be mindful that the decisions you're making after that are typically to help you acquire those shares as a person. So there can be obviously high costs, and it's just a lot of people obviously think, I'm going to get my tax relief, and it can be a big hit because you can spend a lot of money and you may not get the tax relief you're expecting. But that doesn't mean you shouldn't do it, because in the end, even if you spend 50 grand, I spent about 30 grand on mine, but if I've got 300 grand of sales, that's the cheapest marketing probably ever over a 5-year period. Mm-hmm. So people worry. I know it's nice to get the tax relief, but it's not the only reason you would do the decision, because in the end, the upfront fees are relatively low for a lifetime value of a customer if you manage to successfully integrate an acquisition.
Okay, thanks. So,
does that make sense?
Yeah, no, it does. It goes for buy side as well.
Yes, yeah, it goes for both sides.
Sell side, I mean.
Yeah, it'll go for both sides. Yeah, sellers as well. I mean, obviously, when you work out gains, you can, for like the seller, there might be certain things they can net off of the gain, especially if they're selling things like inventory and things like that. So that's why it's quite independent, because it, everything can have different costs associated to it at different points in the process. So that's a general rule of what you could maybe go off.
Okay, thank you.
Does anyone else have any questions? Hi there.
Hi, Julie. Thank you both for great content. For a first time, I'm buy side. For a first acquisition, is it as straightforward as this? Maybe, maybe not. Would you have thoughts, or is there a general principle on whether asset or share purchase is better?
Well, I'll say from a accountant, maybe then Al can say from a legals. I think if it's the first time, I mean, I did a first time acquisition. It was my first acquisition and I did an asset sale. But that's because ultimately I had an infrastructure of a business model where I could integrate those assets in. If you don't have an infrastructure like that, then it can be hard to onboard assets commercially, because the reason you would probably do an asset sale is because you're trying to somehow benefit from those assets. Maybe not immediately, but over a 3 period.
Right? You've got nothing to add it to.
Yeah. So therefore, if that's the case, then if there's nothing to add it to, it doesn't mean you can't do it. There may be a reason, like, for instance, in my industry, some people go and buy just 20 or 30 clients from a small sole trader, for instance, where it's quite a simple transaction because that's just their way, rather than they want to grow organically. But they would still need an infrastructure there to be able to serve those clients. So you'd then say, well, why wouldn't you just do the shares if it's, minimal balance sheet anyway, with low risk? So I don't think there's a right or wrong, but obviously you do need an infrastructure there to be able to onboard the assets.
Yeah. Are you, simple things for simple minds here, are you saying horses for courses, really?
Well, I think asset sales are hard for a first time buyer if there's no business model to integrate it into.
Yeah.
Is basically what I'm saying.
Thank you.
Okay, I actually have a slightly different view, which is to say it's probably not going to be your decision because it's so heavily tax driven, right? The things that will drive the decision are going to be what Julie and I spoke to at the top, which is it's going to be tax structure or like existential risk. So is there a good reason for the buyer to do a share sale? And in which case they will insist, and you're going to end up taking the shares, because if you want the deal, they won't sell unless you basically pay up for the difference. And if you don't have the infrastructure, which you've already said, then you're just layering cost on cost at some point. That said, let's say there's something in this company that is like an extinction level event, which means you do not want to buy the whole thing and take that risk. One you often see is around like environmental liabilities, for example. So back in the day, I used to do a lot. These were bigger transactions, right? But a lot of property stuff. Now imagine you've got an industrial property with a load of like contamination. You might say, I do not want to be spending £2 million cleaning up somebody else's mess. I am just going to buy the property, right? Yeah. At which point, you're then just having to take the extra cost of setup on the chin, because nobody wants that existential threat hanging over their heads and all the like, reputational impact and all of that sort of thing. Or the thing is in trouble and it's just so cheap that you can pick up the assets for cheap without having to take on all the rest of the liabilities, and you're going to leave that for the liquidator or the administrator, at which point, again, you might say, okay, I will handle the disruption, the fact that I'm going to have to get myself a company set up, I'm going to need to get it banked, I'm going to need to get an accounting system, I'm going to need to get everything sorted out, and like accept that your first 3 months of trading are going to be chaos. But to Julie's point about value creation, it may be that the upfront cost and hassle of that is great if you're picking something out of administration for peanuts. So I guess if I were to sort of distill that into sort of a sentence or two, what I'm saying is there is no right answer, and that it will become obvious when you start looking at a deal which way you're going to need to jump, and then you just have to sort of like price it in whichever way you go, basically.
Yeah, and just something, there's a lot of richness in what you said. Brilliant. On what you said in the environmental risk scenario, that would that be part of kind of due diligence and risks and contingencies? And then you'd say, right, because the thing that came through for me is, right, the first thing I'm going to do is get the right advice. So my job is to get the right team on board, because I'm not going to be, I need to get the right deal and make the numbers work and let the experts do their job.
I think that's right, and I have definitely seen deals that started life as share deals. Again, these are at the bigger end of the market, right, as a general rule. But like, I've definitely seen things that started off as share deals, and then something came up in DD, and people still wanted to do the deal, but the buyer did not want to take the risk on that thing, and so they've ended up swapping it to an asset deal. Now, that is a painful and expensive exercise, because you basically have to put all of your deal documents in the bin and start again. You're basically doing 2 transactions with the lawyers, which is like, it's no fun for the client. But you know,
I guess they're making a call at that point as to say, are we going to swallow that, or are we going to walk away?
Nailed it. That is exactly what is going on. You have to say, do I want to pay for this twice and get the asset, or is it too big a risk and I'm just gonna walk?
Yeah.
Brilliant. And the one thing I would just say to that, to caveat, is in bigger deals, but in small deals, I mean, obviously small deals, financials are easier to interpret. So like, I actually had an acquisition on the table. That was an accounting practice that started as a share sale, and we transferred it to an asset sale. I ended up walking away in the end, but it didn't cost me a lot of money. I mean, I know that I'm the advisor, but I think this is where buyers getting the right advice at the right stage, because what happened was, this is what I help people when I do, because I do a lot of coaching sort of strategy sessions when people are moving to heads of terms. Before heads of terms, if you get the right check of the balance sheet, I saw something that was of risk that perhaps a non-financial professional wouldn't have seen if they didn't have the right advice. But obviously I do it. So I saw it, and they couldn't give me, even the accounting firm couldn't give me the answer of the deal. So I just said, look, if this materializes to be what I think it is, because I had an indication that there's something was going to come out, I just said, look, you know, we're going to have to change the structure of the deal. I hadn't really spent any money at that stage on myself, obviously on legals or anything, because I was doing the financials first. And anyway, it came out, it was an issue. I ended up working with them, telling them what the problem was. And it was absolutely fine. I just explained, look, I can't do a share sale now because of this risk. It's going to have to be an asset sale. And they were fine with it. Now, in the end, I ended up pulling out and we parted ways because I found other things throughout the DD process. So I think it doesn't have to cost you lots of money to find it out. You just need to get the right professional advice at the right stages in the journey to assess things. So I always think top level balance sheets are important.
Early. Yeah, sorry. You weeded it. Of that issue, you weeded out early.
Mm-hmm. But we've done it a lot with people. So I remember we were working on someone that was buying this company, and the seller had a business plan, and they sent the business plan over. And anyway, it just said there was all this staff, and it said anyway, we did a top sense check of the P&L. And basically the salaries were £100,000 short for the full year than was in the business plan. So we were like, why are you £100,000 short if all your roles are filled? And it turned out that a whole nother entity that the buyer didn't even know about, and they were cross-charging, I think it was the FD or something, you know, like it was the brother or something, and he was pretending to be the FD, and it was in this other company. And all this £100,000 was in a different entity, and it wasn't even included. So you think even there, you're 300,000 to 400,000 out on your valuation.
They thought they could pull that off. Wow.
Yeah. This is a whole other webinar. I could give you hundreds of examples. Like Al's smiling. I'm sure he's got.
Well, we talked about precisely this problem on our podcast. Actually, if you want to go and listen to some of the things that Julie's talking about in a bit more detail, Hittel, we actually talked about this specific example. I recall with the missing role on that podcast, and I agree with Julie. People think it sounds self-serving when I say getting people involved at heads. It is the best decision you make, I think, because if you get somebody like Julie to do a high-level financial sense check, or you get somebody like me to actually like really kick the tires on a properly robust and detailed set of heads of terms. You have firstly, you know whether or not you're going into something that checks out, and secondly, you have a roadmap that saves the lawyers arguing a whole lot when you get into sort of proper long form deal documents, and you can take a lot of cost out of the deal by spending up front.
Isn't it preventative? I mean, if, for example, if I was to come to the table with, not willing to scare or be aggressive, but just to say, look, we've got a sensible team in place, and half the shit they were thinking of pulling, they wouldn't do it.
Yeah. Or if they do start pulling those tricks, you spot it early for cheap. A set of heads of terms, and this is a bit of wet finger in the air, so don't take this as gospel, but I'd say they're usually like 10% of the price of a small acquisition. So for a tenth of the deal, you can get a very long way to deciding whether or not you've got one. And I had one recently, was an asset deal, special sit. Seller was in serious trouble, was looking like it was going to the wall, acted for a client. We saved, I think they would have ended up buying this thing for well into 7 figures and then regretting it had they just plowed in. But because we did a detailed set of heads of terms, the seller reacted a certain way to those heads. They then went off to their board meeting, my client, and had a detailed discussion about whether or not they were comfortable with what was going on, and they came to the conclusion that they weren't, because they thought that the seller was playing tricks. And so he saved himself, seven figures of transaction costs, including the consideration, and an integration nightmare, because we flushed out early that the buyer was, trying to get the best deal possible for itself at the expense of the seller was trying to get the best deal possible for itself at the expense of my client.
The kind of meta lesson I'm taking from this discussion, which I'll let someone else speak as well, I'm sure there's people wanting to speak, is factor in, expect the unexpected, but factor in costs and energy and time, in the process, and you'll have to kiss a few frogs. Does any of that make sense? Or
and deals do fall over. If I talk about my own acquisition journey, taking my lawyer hat off for a second, we are in the process, my co-founder and me, of doing deal 3. We've been at this 2 years. I think I have assessed 85 transactions, most of which have gone in the bin. It's not. I don't think it's a case of kissing a few frogs. I'm kissing way more frogs than I am finding princesses. That's for sure.
Wow, far smarter doing that than starting up and building. Brilliant. Thank you so much.
Any other questions? Okay. Well, that went pretty well then, Al, in the end with those questions. But anyway, we will send out the recording, and we'll send out contact details for everybody, so you can have a think, and if you do have any questions, then you can come back to us, on legals or financials afterwards. So anyway, thanks everyone for coming. Really nice to see you all. And like I say, I've just launched episode 51 on the Build and Exit podcast today. So loads of I've had, but if you want to hear some horror stories, just go listen to the whole 51 episodes, and you'll see every scenario going buyer and sell side, private equity, 9-figure deals, management buyouts, Al's deals. So we'll send out the link to it as well if anybody wants to see it. But thanks everybody for coming on, and hope you enjoyed it. We'd love some feedback afterwards, and we'll send the recordings out, and if you need anything, then get in touch.
Thanks very much.
No problem. Thanks everyone.
Thanks, Julie.
Bye.
Bye.